at the end of the day, you can make money in any market as long as you know it well, but it's all about mastering a market.
Hello, and welcome to Mornings with Joel, Commercial Real Estate Podcast, where we focus on rising stars and established players in commercial real estate and talk to them about how they are building legacies in today's marketplace. Hello, welcome all. This is Joel Miller from the Mornings with Joel CRE Podcast. How are you today? We're very happy to have you with us. As our guest today, we have Aaron. And Aaron, I'm going to let you pronounce your last name so I don't screw it up.
No problem, Joel. It's a little bit tougher than Miller, but it's Fragnito. Nice Italian name here. Yeah.
Okay, there you go with the emphasis on the Nito. Okay.
But, hey, bada bing, bada boom. I'm from Jersey, so don't mess with me, Yeah,
There you go. That's it. No, I appreciate it. So, well, good stuff. Happy to have you with us today. Aaron Fragnito from People's Capital Group, and we're going to be talking with him today about real estate and the model that they've used actually in order to grow their portfolio. I know a lot of you come here for the educational content related to the show, and so we thought that this was a very good model because, Aaron, I know just a little bit about your background. You started off basically as a realtor and doing some other things in real estate. So if you don't mind, why don't you introduce yourself and tell us a little bit about your background? How did we get to where we are today?
So, Joel, I appreciate it. Thanks for having me on the show here. I read Rich Dad Poor Dad, the Purple Real Estate Bible, 2009, graduating from Rowan University, entrepreneurial degree, dismal job market. I think I went to a job fair that there were two companies hiring, and it was either I was going to work at Enterprise, rent a car, or sell insurance, and neither one just excited me. I didn't have a passion for either one. So I really wanted to own real estate, large scale real estate. I just didn't know anything about it, didn't have any money or experience. And I moved out to Steamboat Springs, Colorado. I taught kids how to ski for 6 months after I graduated school. And I just read a lot of books on real estate ownership, and they all made it look so easy. You just go raise some money and buy an apartment building. So went back to Jersey, 2010, got my real estate license, and really the only real estate you could sell at the time was short sales and REOs, foreclosure properties. So I was forced to learn short sales and REOs, and that was great for me because I met a lot of investors doing that, and I got into flipping houses and made a little dough doing that, and started selling some short sales, teamed up with a short sale negotiating company, got a good flow going there. And I would staple signs to telephone poles to say, "We buy houses," and I'd get some deals that way. And I started buying properties and selling properties, and teamed up with the wrong partner who ended up stealing money, and then found a good partner, Seth Martinez, who I am still partners with to today of People's Capital Group. He owns the other half and runs the operations side of the company. And Seth really complimented my weaknesses, and vice versa for me as well with him. He had sold a medical billing company, so he had some liquidity. I was great at sourcing deals. I was running around sourcing deals kind of as a wholesaler and a realtor. So we ended up buying a 6-family in Newark, New Jersey together. We spruced it up, renovated the units, leased them out for fair market value, refinanced all of our money back out in a year. And we were like, okay, light bulb went off. Like, we can recycle our cash and buy more properties. Pretty quickly ran out of money, realized we needed to raise capital to buy larger assets, and started raising capital with our group, New Jersey Real Estate Network, which is meetup.com. We have about 5,000 members today, and just speaking at different real estate associations and going around the tri-state area and making connections and raising capital from real estate investors or people working, 9 to 5s or 9 to 9s, whatever it is, and wanting to get into real estate passively and raising capital on a passive level. Developed a management company in 2015 after firing 2 other management companies, one which was, again, stealing money from us. I get stolen from on every one of these stories here. That was a great experience there, learning that we needed to have our own staff and our own team in place to really properly reposition these old vintage apartment buildings and make them new or like new, and really get all the value we can out of them for our investors. And so developed our own management company in 2015, really fine-tuned that through the years, and just been buying bigger and bigger assets here, strictly in North Jersey. vertically integrated, focused on properties that allow you to commute into Manhattan in less than an hour in the multifamily space. And that's been a good recipe for us and our investors through the years.
All right. Well, that's a good foundation. Certainly appreciate that background. And you mentioned that you're mainly focused on northern New Jersey. What's the logic behind that? I'm pretty sure I know since I'm in the game, but you tell me for our audience. Why are you just focusing on northern New Jersey at this point?
Yeah, well, I mean, most syndicators say, hey, Dumbo, why do you do North New Jersey? It's got rent control, it's a blue state. You can just go to Florida, go to Texas, go to the Carolinas like every other syndicator, and go to Phoenix, go to these markets where it's easier to be a landlord. How stupid are you? And they, they're not that mean, Joel, but that's pretty much the message, right? So, and the bottom line is we offer a different product. A lot of our investors, about 90% of them or so, are in the tri-state area. Or at some point they grew up in Jersey, they went to school here, something like that. And they saw these markets boom and they see the opportunity here. And a lot of them are very local to these assets and they like the ability to be able to drive by the building and see it, or come to the office here and see our staff and see our operation. And so really, we offer a different product. We offer a different service, where you can invest locally in one of the highest demand markets in this country. New Jersey is the most densely populated state in the country. We have some of the best schools. We have the highest income per capita. We have, the shore, we have the mountains. You can go dance in Hoboken and you can go enjoy the rural. Jersey actually has a lot of farms, like beautiful rural areas too. You can go skiing.
Garden State, right?
Garden State, bro. Absolutely. We got the Jersey Shore. Do not let Snooki represent Jersey here. Okay. Most people fly into Newark Airport and they're like, oh, industrial area. We got the Sopranos and Snooki representing us here. We're actually very well educated. We're high earners. We're hard workers. We're fast drivers. And we know what we want here in Jersey. We all really have to squeeze into one little place. And by the way, the harder it is to develop real estate and build new real estate means my real estate values and my rents will continue to grow because there are so many people that want to and need to live in Jersey because they work in Manhattan or they work in a Fortune 500 company here in Jersey. That they need a place to live around here. So we offer that product of renovated vintage real estate, and there's just an insatiable demand for housing in Jersey.
Yeah, yeah, very good point. You mentioned a couple of things there related to the idea of people being able to drive by and see the property and everything else. And speak to just a little bit more about understanding a market because you're in North Jersey as opposed to some other area that you hear is great in another part of the country. Do you really find value with that?
You know what it is? It's not like, we've cracked the code and found the best market in the whole world. At the end of the day, you can make money in any market as long as you know it well. But it's all about mastering a market. It's about having those relationships with brokers so you get the jump on a deal first and you get your bid in before anyone else knows about the deal. It's about having those contractors that no one really knows about because they don't need to advertise because we keep them so busy and their names aren't even on the truck, but they do great work for a great price. And just being able to buy properties without having a bidding war, we don't buy anything sitting on the internet. The deals we buy are top secret, off market pocket listings. We know the brokers. We get out there first. No one else knows about it. We have like 72 hours to submit an offer and lock up the deal. And that's how you buy real estate for a great price. And then the infrastructure, the boots in the ground, that's taken years, a decade to develop, is really also part of the pie for success in real estate. So it's having those relationships in place, sourcing those deals off market, and then having the infrastructure to reposition them aggressively and efficiently. You can do that in almost any market, but just pick a market and focus on it and develop those relationships and that infrastructure. And that's how you find success in real estate at the end of the day.
Yeah, yeah, very good point. And I wanted you to bring that out because there's, as you mentioned, opportunities everywhere, right? And so if you're in the industry, people would say, well, look over here, but you can't chase every shiny thing that's out there, and having expertise in an area certainly
but
is
just
of
pick
value.
a market and
You
focus
mentioned about
on
the
it
avert
and
the
develop
upgrade,
those
and
relationships, that
that's
infrastructure.
something that
And that's
a
how
lot
you
of
find success.
people sometimes struggle with. Do I stay where I'm just contracting this work out so I don't have that overhead every month? or do I become vertically integrated and take it up to the next level? At what point do you feel that it was necessary for you to become vertically integrated, other than the fact that you said your contractors was, certain contractors were stealing money from the firm? So how would you answer that?
Sure, sure. And there's different levels of vertical integration, right? Like, so we used to have contractors on payroll, the guys swinging hammers. We used to have them on payroll, and all of a sudden, the jobs took longer to complete and cost more money because they got paid by the hours. They got paid whether they're working or not. And we quickly recognized that there's different levels of vertical integration, and we wanted to have the management in house, but
Mhm.
not necessarily the contractors. Okay, so we hire general contractors. We generally have about four general contractors going at any time. They'll be managing anywhere between 1 to 4 teams themselves.
Mhm.
And they have their own insurance, they're their own companies, but we keep them so busy, they don't have to spend a dollar on marketing. They don't have to run around and get their next job. We have their next job for them, and they give us a good price. They do good work at a quality pace as well. They stay on budget and on schedule. And if they don't, we can easily fire them because they're independent contractors, right? So there's no like unemployment we have to pay or anything like that, right? So we can be kind of fast to fire and slow to hire. And we really believe in working with independent contractors as much as we can. I have about 4 virtual assistants myself. We have about 3 virtual assistants in the property management company. It costs about twice as much money to bring someone into your office, give them an office space. Here in North Jersey, right, you need to be making like at least 65 grand a year to just like eat. And that's like minimum, bare minimum. But I could hire a virtual assistant for maybe, 20,000 a year or so who can do the job just as well, depending on the job. If it's bookkeeping, if it's boots on the ground, like our head property manager, so we do have people on staff and
Sure.
on payroll. But it costs about 50% less to have someone as an independent contractor and work with them in that sense. And then, you know what, if things slow down, they're not on payroll. So you can take a break with them, or if things speed up, you can hire more, kind of more efficiently, more effective because they don't have to be local.
Right.
So not every job is right for a VA or an independent contractor, but something like we find actual, contract construction itself. Because I own a real estate investment company. Owning a construction company is a very different business. And quite
It is.
frankly, I don't think I'd be that great at it. So, but you have guys that have been in construction for years and years and years. They have the teams, they have the crews, they have the insurance. And those are the guys, those licensed guys we work with. But they're not always like just sitting on like the good guys, the good contractors, you got to like kind of go and find because they don't really need to advertise. So a
Mm.
lot of it's word of mouth or just like going to Home Depot in the morning and like finding the guys actually doing stuff and getting materials. And we run a very lean and mean management company here. That's how we do it.
Yeah, yeah, that sounds good. That sounds really good. So appreciate you sharing that kind of inside look behind the curtain, related to the operation, because that's what a lot of people want to know as well. You mentioned also about the value of having a good partner. Generally, a lot of times people are willing to partner with anybody that can give them a dollar. What have you found to be really the value of having a good partner as opposed to a bad partner, even if they have a ton of money?
Sure, sure. Well, I've had both good partners and bad partners, so I can answer that. And it's really like a marriage in a sense, and I've had one of those as well. So I could probably give you some advice there too. But so basically, at the end of the day,
Mhm.
you gotta first look at your weaknesses, right, and be completely brutally honest with yourself. Like, what are your weaknesses? What are your strengths, right? And partner out your weaknesses, right? And that's a common saying, but what does that really mean? A lot of times for me, it was money. First of all, I didn't have any money getting started in this business. I did want to team up with someone who was liquid. And my first partner just filed bankruptcy. So you had two broke guys trying to start a company, and one failed more than the other. At least I was fresh and hadn't
Mm.
filed and never filed bankruptcy, right? So um, and he ended up like just taking money from the operating account because he was so broke, and like getting the wrong insurance for the like everything, just not holding up his weight. And then my other business partner, Seth Martinez, to today, he was liquid. He sold a medical billing company, but he was also already doing operations. He was already buying and managing his own multifamily real estate in northern New Jersey.
Mhm.
and he was executing on managing contractors, on managing management companies, and all the headaches of permits and bureaucracy and whatever it is, invoices, services that you deal with on the operations side, managing people. And I'm more of a visionary. I'm more of a marketing, sales, client relations type of individual. So I needed someone to kind of make sure the trains run on time, and that when we buy these buildings, the whole 5-year renovation strategy is executed. Because quite frankly, raising the capital, doing the underwriting, having those relationships in place, finding and sourcing the deals is just half of the business.
Mhm.
Once you buy it, the work really starts. Now you got to manage those contractors, lease up the units, manage the leasing staff, the management staff, and so on, and make sure you hit your marks for your investors. Or quite frankly, they're not going to invest in you again. Right. And that's why 80% of our investors reinvest, because we hit those marks. We try to do what we say we're going to do. And so that was it. I looked at my weaknesses. I'm not really an operations guy. I wasn't liquid. And that partner wasn't great with public speaking, or, Seth, he's not great with marketing and sales. He's kind of a hard ass, but you have to be, as you're managing contractors. You can't be like, oh, like pals. I'm a people pleaser. I try to make everyone happy. In the construction business, you cannot be a people pleaser.
No.
You got to be like, is it done? No, get back to work, and like just be right straight to the point. There's no gray zone when it comes to operations. It's either done or not done. And so that's the type of guy he is, and that which pushes me too on my end, as a business owner myself. But we stay in each other's lane. We respect each other. We've made money together. We've lost money together. We've been through thick and thin. So it is similar to a marriage, and you might not agree on everything, but you've got to respect each other's opinion and know kind of when to butt in and when to just let them do their thing and let them kind of report back to you. And, we all make mistakes, but as long as you're fixing those mistakes and always improving, that's an important part of a partnership.
Yeah, yeah, those are very good points. I tend to think about my own partnership. My partner has developed over 15,000 apartment units,
Wow.
but I'm not I don't build buildings. I'm not in the dirt with the contractors and the GCs like you're talking about. I'm the guy bringing the money to the table. So, that's the difference. So what he doesn't do well, I do well, and vice versa. So completely agree with that. It's a very, very good point, and something that's necessary if you're going to have a successful business. So,
Yeah.
hey, thank you for sharing that. Let's talk a little bit about business model. There's a lot of different ways that you can do things. And, you mentioned that you've been buying kind of these older buildings and kind of rehabbing them. So what exactly is your model? It looks like you're not doing development. It's more of a value add play. And, are you looking to do larger buildings? Or are you sticking with the smaller kind of mid-size
Mhm.
institutional capital? Kind of what's the mindset?
Yeah, exactly. So we find there's kind of a sweet spot between like 50 to 120 units where it's too small for institutional capital to get involved, but it's too big for mom and pop investors. And there's a lot of inventory like that out there. So we kind of focus on that middle market area, and there's a lot of older vintage real estate that's just mismanaged, outdated, deferred maintenance, but it's in a great location. Right. And there's one thing you can't change about real estate, it's location. So we buy based on that, generally within an hour commute to Manhattan. The building we're buying right now is a 12-minute drive to Manhattan. It borders the #1 hospital in New Jersey. Across the street from it is the Hackensack High School, and rents are 50% below market value. This is kind of a classic mismanaged, outdated, older vintage apartment building we can reposition from a class C into a class B. And that's what we look for. It's a diamond in the rough. We'll look at over 100 deals. We'll submit 20 or 30 LOIs. We'll get one deal. So we're very picky on what we buy. But right now we are seeing opportunities, which is great. And we do like Class A real estate. Listen, I'd love to just buy Class A real estate all day long. It's a nice, easy manage. It's
Mhm.
very hot commodity on the resale market as well, and lease up market. But you don't see much value add in Class A. Now we are getting close on one that's in Newark, New Jersey, that has rents below market value. It's kind of mismanaged. It was built 4 years ago, a beautiful Class A building, but it's mismanaged, and you don't find that very often. Generally, people that own Class A know how to own real estate. But sometimes you find developers that are great at developing real estate getting it approved, building it, and they have this beautiful product, but they're just not good managers. And because of that, now it's mismanaged and they're motivated to sell. Maybe they still have a high interest construction loan on or something. They weren't able to refi out into lower interest debt or whatever the scenario is. So we do look for mismanaged class A, B, and C real estate
Mhm.
within an hour commute to Manhattan. And that's been our recipe for success here.
Gotcha, gotcha. Yeah, no, it's a good point. And I specifically kind of honed in on what you were saying about going from a class C to a class B. Many people always want the nice glossy class A properties, but at the end of the day, I often compare it to the hotel industry for an example. I mean, you can have well, I don't want to mention any brand and offend anybody, but you could have a class A hotel basically with all the amenities and everything else, or you could have a limited service hotel, and actually that limited service produce higher ROI,
Sure.
percentage wise than a full scale hotel where you have, to pay for all these additional services and everything else. So if you're looking at it from a bragging perspective, the class A is where you want to be. But if you're looking at money in your pocket, class B is certainly a good place to be. So
Oh yeah, I've had many a nice nights at the Red Roof Inn, my friend. The day that especially.
yeah, but you get the point, right? I mean, it's a matter of what's making money. And
Absolutely, absolutely.
yeah. So I mean, you got to do what makes sense. So I certainly appreciate that. You mentioned also actually we're gonna take a quick break for our sponsor, and then we'll come right back and have another question for you.
All right.
The Morning for Joel CRE Podcast is sponsored by ImpactMask.com. That's M as in Mary, ImpactMask.com. The world's most breathable mask that has 99% efficacy, which is higher than an N95 mask, and it won't fog your glasses. Check out the science behind these incredible masks at ImpactMask. All right, sounds good. Appreciate that. So, I wanted to talk to you a little bit about you mentioned pocket listings and things of that sort. That's what everybody wants is those pocket listings, but easier said than done, right?
Mhm.
And so, what do you feel has been the success as to why you can now get those pocket listings and that the realtors and other people like that call you first as opposed to just putting it on LoopNet or something else at that point in time?
Sure, sure. Yeah, and you make your money when you buy in real estate. So it is important to have these relationships in place. It's really where it all starts, but it takes time. It takes years. Think yourself as a broker, right? You're not going to really just like want to sell a deal to just anyone because if the deal doesn't perform, the buyer doesn't perform, it doesn't look good for your seller. Your seller's not going to like you. Not going to give you another listing, and also you don't get paid, right? Because they work on a commission basis. So it takes time. You build a relationship with a broker, just like you do with an investor, anyone in business that you're trying to do serious business with. And you start to gain a reputation when you invest in one market continuously as well. And brokers talk and, they see you buying real estate. So they want to work with you and you want to work with them. Now, there's two types of brokers out there, Joel. You have your buyers brokers that kind of work best with buyers, and you have your sellers brokers that work best with sellers. So we like to buy deals from buyers brokers. I'm not talking about really representation legally or anything like that. Don't get confused with residential real estate where you have your buyer's agents and your listing agent. I'm talking about a guy that gets a listing or he's about to get a listing and he calls you up first. He says,
Mm.
I got a deal. Here it is, 78 units in Hackensack, New Jersey, next to the best hospital. Rents are way below market value. The guy's motivated. His investors need to get paid in like 3 months. He needs out right now. Here's the best price he'll take. Come look at it tomorrow. Give me an LOI by Friday, and it's yours. No one else will know about it. That's the type of guy I want bringing me deals. That's a good buyer's broker. Okay. Now, he's actually going to represent the seller and he's going to represent me in the transaction. By the way, don't bring in your own broker. Oh, give him the full commission, right? Money makes the world go round. And forget about representation. Like you represent yourself. Take the numbers he gives you with a grain of salt. Do your own due diligence. It's not residential real estate. Forget about fiduciary, whatever. You're looking for deals, not representation. So that's a good buyer's broker. You give him the full commission. He's going to bring you the deal. He's going to bring him more deals beyond that because he doesn't want to go around and deal with 15 different bids and showing 35 different buyers. It's a big waste of his time. If you can get the price the seller wants, deal with one good buyer, then he's going to go out. It's an easier job for him. And then maybe you could charge the seller a lesser commission, right? Everyone wins. So then you have your seller's broker. Now we go to sell assets. We do not call up the buyer's broker. We call up the seller's broker. These are the big guys. They're going to be blasting it out to 10,000, 20,000 buyers. CBRE, Berkadia, Marcus and Millichap, Cushman Wakefield. These guys are not who we like buying real estate from. We like selling real estate with them. They're going to do all the professional marketing. They're going to put some dollars behind it. They're going to blast out to all our buyers. They're going to have their interns hit the phones and get people out there. They're going to get 25 offers on the table. They're going to show it to 50 other and they're going to bring you the best buyer and and a number of bids, right? You're going to get a bidding war going ideally for your real estate. That's not how you want to buy real estate. That's why you want to sell real estate. So you have to know what type of broker you're dealing with. Is it one that specializes in buyers or specializes in sellers? And make sure you're using the right broker for the right job.
Yeah, yeah, good point. Thank you for sharing that and bringing that up. But you're right. It's about the track record. Even in development, and I think that's very important. I was at a meeting the other day where there were some bankers talking about deals that weren't performing, and the sponsors on the deal just kind of wanted to walk away, and the lenders were basically saying, it doesn't work that way. If you committed to do something, you really should try to commit to delivering on that. And so you have to have the right mindset. If you have the right mindset, then you will get those type of phone calls and be able to take advantage of those opportunities. So, thank you for sharing that. It's all about performance, and then the performance leads toward greater success and greater opportunities. So
Yeah. Yeah.
you're absolutely right. Yeah, I just out of curiosity, how long you think it took you to get to that point? Because you said you pretty much started off with nothing. So how long did it take you to really kind of build that up to where you were able to start getting those calls?
It took a little while, probably a couple of years, but I mean, honestly, in the market where we started in 2014, like, uh, uh, realtors really wanted buyers, right? They're like, no one was buying real estate, so like, we would take them out to lunch, and kind of schmooze them, and that, yeah, that's how we got on the top of the list. Um, we also did a lot of residential for many years, so that was a little different. Residential's they're not as loyal in the residential market. It's kind of, they tend to have a number of buyers there, but I would say just more so on the larger assets, probably more so like the last couple years. It really took a while to build those relationships because a lot of the brokers are going to look at tax records. What properties, when you go to buy a property, you look around. Like, I just got to jump on a great deal in Passaic and also in Hackensack because they're looking at the tax records. They're talking to other brokers that are selling deals in that market. And, they're seeing you buy real estate in that market. And they're like, okay, this guy's a player. So you kind of got to cycle a few deals to get there. But generally, if you have a relationship in place, you're taking them out, you're staying on the forefront with phone calls and whatnot, you're telling them what you want, to be very specific with your buy box. I'm like, oh, I buy anywhere and I buy everything. No, like, I buy these types of assets with this type of value add in these markets. And here's how we structure the closing and da da da. When you do close a transaction, try not to nickel and dime me. Listen, there's going to be retrades here and there, but try to be fair about it at least, and not waste people's time, and be transparent when you run into challenges. Like, the sponsor, you have trouble closing, explain what's going on, and explain what the challenges are, and be transparent. Oh, I need 60 more days. My biggest investor just backed out or something. Here's what we're going to do to solve that. And people can work with you a lot of times. They really appreciate transparency in business. So, but it takes a while, my friend. Just like any investor investing in you takes time, a broker trusting you with their pocket listing takes time too. Because remember, if that buyer doesn't perform, there's a good chance that seller's going to be like, all right, see ya. I'm going with one of the big, I gave you a shot. You said, I'll bring in the best buyer ever. I'm going with one of the big guys now. They're going to blast it out to their 15,000 buyers and get me a bidding war. You'll see this on LoopNet in 2 weeks, and then everyone loses.
Yeah, yeah. Very good point there. I certainly appreciate you diving into that a little bit more detail. Let's do this. If there's any questions that are out there, Jomar, you can start getting those into the chat, and we'll start answering those in the next few minutes. So we certainly appreciate that. So while we're waiting on that, just wanted to. There's two more things I really wanted to with you and kind of go over today. You mentioned about starting with nothing, and a lot of people obviously they kind of started the same way. What are the lessons learned now? The old saying, if I knew back then what I know now, things would be different. What would you say were those things that were really valuable that maybe you didn't appreciate back then, or you wish you would have known back then that you would have done differently that would have accelerated your growth?
I would say what you said towards the beginning of the podcast, what many entrepreneurs are guilty of, which is this shiny object syndrome. And I'm so guilty of this myself. And it's probably the greatest mistake I've ever made in business is to get off track. I remember I was reading, I was following like Joe Fairless years ago. It's like 2013. He's like the first guy teaching this thing no one knew about called real estate syndication. And my business partner and I are like, we want to be real estate syndicator. This is great. We start People's Capital Group in a cafe in Hoboken, New Jersey. And we're like, all right, we're going to do this. So we go out and raise, money to buy a 25 unit in South Jersey. And we raise from friends and family. And we're like, all right, we raised, $500,000. We bought a small apartment building. We're awesome. We're the best real estate investors ever. We're, hiring and firing third party management companies. We're figuring it out. And then we go to buy our next one like right away. And we realize our friends and family are tapped out. And so we start to raise capital from the general public and totally blew it. Didn't really know how to raise capital, didn't really understand it, and it basically pivoted our model to fix and flipping houses because there was a lot of opportunity to buy fixer uppers in that time. And there was a lot more people that wanted to invest for 6 months in a fix and flip. We could give them a 20% return in 6 months. And that was an easier dollar to raise. And it was maybe, an easier uh property to acquire, right? And so we focused more on fix and flipping properties and wholesaling properties. And we did very well. We wholesaled about 100 deals from the sheriff sale auctions and 2014 through 2017. I mean, we made hay while the sun shined. And we made some nice wholesale fees and we fixed and flipped some properties and we lost money. We made money there. We kind of licked our wounds for sure in the house flipping industry and learned, it's not if you're really good at flipping low end homes, don't try to start doing $1 million homes. That we learned that one the hard way. But we got off track, and now it's not all bad. We learned a lot. We built relationships with investors. We built our brand and we made relationships with brokers and so on. And we did acquire, we circled back in 2018 and started buying larger multifamily properties again. And really not even that large. We bought like a 6 family, we bought an 11 unit, we bought like a 20 unit. So, and just started getting into actually learning how to raise capital, actually buying, mid-sized apartment buildings and figuring out the management side of it and cracking that code and doing the hard thing that we couldn't really do before or maybe just didn't want to do. We kind of chased after the quick money and flipping houses. Um, and that's it. Now listen, I don't want to say the word regret or anything like that, but I definitely, if I stayed the path and I just read Joe Fairless's book. That's I don't get $1 out of that, by the way, but or whatever it is, all the gurus out there, right? And anyway, I actually learned how to raise money and how to reposition apartment and like just really like double down like how to raise money, whatever it is, books, CDs, YouTube, and just really learn the art of raising capital and buying and acquiring mid to large size apartment buildings. I would be, on a beach somewhere sipping pina coladas right now because those properties have doubled in value. Those rents have shot up. We probably hopefully would have exited during COVID or something like that, or just whatever. Those values have skyrocketed. And I would now be in a position where I'd have those relationships in place and be able to raise capital very easily because investment relationships take time. You need a full cycle deals. Full cycle deals and apartment building repositioning is like a 3 to 5 year process. That means a lot of people maybe they'll invest like 1 or 2 deals, but they want to see that money come back to them. They want to see you do what you said you were going to do with their money before they write you another check. And that's
Yep.
fair. Um, so that takes time. But if I really focused and doubled down and did the hard thing then and learned something I was uncomfortable learning and uncomfortable doing and didn't enjoy doing, but then learned how to do it well, I would be in a much better spot now. And but I wouldn't even be on this podcast probably. So, it's a good thing I did.
Yeah, yeah. Well, good thing. Good thing you learned a lot from that. So that's where the value is, right? So now you can speak to that. Let's talk about that also because you talked about you know, understanding capital, how to raise capital. I found that the biggest thing just living in the United States of America is understanding having access to capital is like the biggest thing in the world if you're going to be successful in this country for the most part. Um, a lot of people don't know how they can invest. They have a 401k that's locked up. They got an IRA that's locked up. At least that's what they think. So tell me and tell the audience, what do you want people to know as it relates to how they can actually invest in deals by using instruments that they think might not be available to them, but might be available. Can they use their retirement plans? Can they use this? Can they use that? Why don't you
Sure.
speak to that a little bit if you don't mind?
Yeah, absolutely, Joel. I mean, that's I was just literally having a conversation yesterday with a friend of mine, and he was saying, "Well, I did really well in crypto. I'm like, I'm way up on crypto. I don't want to sell because I'm gonna owe a bunch of tax. And my stock portfolio, again, I have a low. If I sell, I'm gonna get nailed in taxes. And so I want to get into real estate. I love what you do. I've been following you, but I don't have any liquidity. Right now. And if I pull out of my other investments, I'm going to get nailed on taxes. I don't want to do it." And I said, "Yeah, you're absolutely right. Keep your money invested in those asset classes, especially if you're doing well. Keep growing that wealth." And I said, "Well, what are you doing with your IRA?" And he's like, "Well, it's in some mutual funds. I don't know. It doesn't really get that much, but it ticks along with the S&P or a few ticks below that." And I just have it's a bunch of money sitting there, not really doing a whole lot. I'm like, "If you were self-directing your IRA," and he's like, "No, what's that?" And I started to explain to it, only 5% of IRAs are self-directed, and me and you are in the space of self-directing IRAs or, explaining it to people. So it seems like so common. We're so familiar with it, but a lot of people, like 95% of the population has never even heard of it. And they think their 401k from an old job or their IRA, whether it's Roth or traditional or SEP, they think it's just locked into whoever it is, Fidelity or whoever holds it now, and it's gonna
Mhm.
just ride in that S&P 500 mutual fund until, for eternity, until you're 59 and a half, and you can start pulling from it. And that is incorrect. You can self-direct your IRA into real estate. You could self-direct it into a lot of asset classes. There's things you can't do with it. You can't buy a beach house and go there with your family for free. You can't put your kids through college, but there's a lot more stuff you can do with it. And your IRA custodian is going to guide you in that process.
Mhm.
And I mean, I know a group. I work with Gamma Plan. They have and, many other IRA custodians as well, but they do this promo code with my group, and you can start an account there for $1. So it's basically free to start an account. Maybe a couple $100 a year to maintain it, and now you can take your retirement account and take the bull by the horns and invest in things you really have a passion for, and actually diversify some of your money, some of your retirement account out of the stock market. I'm not saying take the whole thing and put it into real estate, but maybe a third of it, maybe 50%, and diversify into an asset class that's truly not correlated with the stock market. Because a lot of people are thinking these days, hey, we've had a good run. I mean, S&P is up like what, 18, 20% a year for like the last 5 years. And historically speaking, it's up like 8 to 10%. I think so it's kind of had a really good run. So like there may very well be a correction at some point. Who the heck knows? But chances are, if you take some chips off the table, you reinvest into um, real estate, which is, a very tried and true asset class,
Mhm.
where we're targeting 20% IRRs, 2.2x equity multiples over 5 years with our value add opportunities. It's, listen, even if the stock market still goes up 20% a year for the next 5 years, you'll be in the same spot. I mean, it'll just be done in real estate. But if the stock market dips or does a correction, then your stomach isn't churning as much at night, because you've diversified some of your portfolio into another asset class that's truly not correlated with the stock market. And most commonly, people do that with real estate, but you could do it with a lot of other asset classes. Your IRA custodian can guide you in that process. It takes like 2 weeks to set up an account and move money over. They pretty much take care of most of it for you. And then you can invest that right into an opportunity, with a good operator and a good track record, in an asset class that a lot of people want to get into, but think they can't. But you can with an IRA custodian.
Yeah, yeah, very good point. Have you found any other methodologies that people are using in order to pull money to be able to invest other than IRAs?
Yeah, I mean, I see that there's the 1031 strategy, right? So I talk with investors often. I'm in touch with them right now that invest actively, and they've done very well for themselves, and they have a number of properties, but they're also full-time parents, they're full-time employees, and they're getting to the point where their success has become, a burden in a way. And like, it's one thing to own a couple, 6 families and manage them yourself or something, but once you own like 4 or 5 of those things and you're managing those yourself, even if you're managing a management company, it becomes a pain in the neck. And, so a lot of people say, "Can I sell my asset, do a 1031 exchange into what you're doing?" And I say, "Yes, you can." It's a little difficult, but there's a process. We do it through a tenants in common agreement, and you essentially can 1031 into a passive investment,
Mhm.
and have a more passive role. Now, you technically are a voting member. You technically need to sign off on the mortgage and sign off on the sale of the asset or refinance, even on new leases. But we try to make it as easy and painless as possible for investors to 1031 into our deals. You can also do that through something called a DST, a Delaware Statutory Trust. And DSTs are generally like 50 million to like $500 million funds. You're going to clip like a nice like 4 or 5% coupon per year and invest in a fund that's invested in like, national real estate opportunities. And um, you'll be more like a number on a screen, but you'll be in a large fund and be like well diversified over a number of assets in a very large fund. So you can do that with a number of DSTs out there. I work with a number of companies that do DSTs. A tick is different. A tick's more like a group like ours. We're buying a $15 million deal. You're going to sell your building. You'll have $1 million in liquidity from it. You roll that into a deal with ours. You own a piece of the deed. You get monthly updates, quarterly financials, quarterly distributions, annual tax returns, all done for you. So it's a passive experience, but you're technically a voting member. You're technically own part of the deed to not violate the 1031 law. And that allows you to then defer those taxes, 1031 into a much more passive experience, keep your money in real estate. And ideally, you can do a little better with some of like the smaller guys like me when you get into a tick.
Mm.
There might be a little bit of additional risk and requirements with it, but ideally, you could do a little bit better than a DST or 1031 to a DST and clip a nice coupon and, be part of a large fund. There's nothing wrong with that either.
Yeah, yeah. And for the sake of the audience, define what TIC stands for, just so that they understand. Because you
Sure.
use
A
that.
TIC, a TIC, is a tenants in common agreement.
Right.
And it's simply a way to own real estate where, you know, for example, the 78 unit we're buying in Hackensack, we have PCG Fund 4, which is going to own, say 90% of the deed. And then the person bringing in the 1031 funds, they're going to own 10% of the deed. So we do something called a tenants in common. That's how we own the deed.
Right.
And that allows us to break up the ownership of the deed so that they're a direct owner of the deed, because you can't 1031 into a fund, not at least an LLC like we structure, an LP fund. You can't be a limited partner in a fund and 1031 into it. Now, let me go a level deeper here. You
Okay.
can do a lazy 1031. And that's a buzzword if I've ever heard one. So what the heck is a lazy 1031? Well, I have a masterclass on YouTube about it, but I'll tell you right now. So a lazy 1031 is it's not a 1031 at all. Just a stupid millennial buzzword here. All it means is you sell a property, you have $1 million from sell an asset, and you owe capital gains tax. Okay, right? Let's say you have $1 million from the sale of a property, and half a million of that. We'll make it simple. Let's say it's all profit, right? It's all profit. So now you have a 25% capital gains tax. So out of that million, you're taxed to $250,000. You're like, okay, what do I do now? Well, you could do a 1031. You could do the tick. Well, you got to sign the mortgage. You're technically a voting member. There's a little bit of risk to it. You could do the DST, but those are like kind of watered down returns, and you're not really going to get that pop you get with like an LP position. So now the third option is a lazy 1031. So you sell the asset, you don't do a 1031 at all. You simply sell the building you're exiting and invest in the new opportunity as a limited partner in the same calendar year. Now, the new deal you're investing in is going to give you a large tax write-off. We're going to do something called a cost segregation study, and we're going to accelerate that depreciation. And with the new tax law, it's even better than ever. And you could take basically a 50% tax write-off on your investment. So if you're investing $1 million from the exit of your previous sale into this next opportunity, as an LP, as a limited partner, where you're truly passive, You're not signing the mortgage. You're not managing it at all. You don't have to sign off on leases. You don't have to deal with the tick. You don't have to deal with the headaches of actually doing the 1031 and the 45 days to find 3 like-kind properties and the 180 days to close and all the kind of the headaches of a 1031. It's very simple. You just sell the asset, you reinvest into another asset. You can reinvest as a limited partner, so you're truly passive, and you take the big tax write-off from that new investment and you use it to write off the gain from your previous sale. So that allows you to therefore, and then in this example here, you're selling the deal, you're making $1 million, you owe 25% capital gains tax, you owe $250,000 in capital gains tax. You invest that $1 million in the next deal in the same calendar year, you get a 50% tax write-off. That's a $500,000 of tax write-offs or paper losses. You use that $500,000 to write off your gain, and you eliminate the majority of your taxable income.
Tax
Now,
liability.
yeah. And this is clear, like that scenario too, that's not really an accurate scenario, because when you sell a property and you have $1 million come out of it, it's not all of it is profit, right? Generally, half of that is your basis, right? You bought the thing for $500,000, you sold it for $1 million, right? So you made half
Put
a
the
million
money out.
dollars.
Yeah, right.
You only get taxed on that $500,000. You don't get taxed on the basis of what you bought it for, right? So your tax is really going to be like 175,000 or something like that, and you can essentially then reinvest, into another deal. Okay, you made a $500,000 in profit on this deal, you're exiting, but now you're getting into a new deal. You're getting a $500,000 of paper losses, so you can write off that gain and now eliminate your gain and therefore eliminate your capital gains tax burden. And that, my friend, is called a lazy 1031. And that is even easier to do than a 1031 into a tick. And that's why I usually advise people to do that. Now, every scenario is a little different. You want to talk to your CPA, but connect with us. We'll see if it's a fit for you.
All right, good point. Appreciate you sharing that. A lot of good information there. Did want to mention also that we did a whole show on 1031s. So if you're listening with us today, the Mornings with Joel CRE Podcast, you can look up our inventory of shows and pull that one out on 1031s as well, and reference that against what Aaron's talking about here, because there might be a different way to do it. Aaron's way of doing it actually sounds pretty good as well. So that's really what we just want to show you, is how you can get this done and a variety of ways of getting it done, investing in property. And Aaron, we're going to wrap up in a couple minutes, but I did want to close out on two things real quick. Active versus passive. I've heard so many people, as I'm sure you have, they say, oh, I want to invest in real estate. I want to invest in real estate. They go out, they buy that single family home, and, maybe they get 2 or 3 or 4, and it drives them absolutely crazy. They're working 9 to 5, then they're fixing houses from 6 to 11 o'clock at night, and they absolutely hate it, and they don't grow anywhere past that. So what would you say for the person who wants to get into real estate, doing it that way, as opposed to becoming a passive investor in somebody else's operation that does this 24/7?
Sure. So there's nothing wrong with owning a couple properties, but you're going to get your hands dirty. And, the first property I ever bought in Newark, New Jersey, I was like, all right, I'm going to do this real estate thing. I'm going to do it. And I'm going to do it all myself. So I bought the property. It was like mostly vacant, 5-unit near Rutgers University, Newark, New Jersey. And, I leased them all the units up to TRO tenants, temporary rental assistants, or TRA tenants. And I was like, man, I'm a really good leasing agent. I leased this thing in like a month, like all of a sudden, like I leased to one TRA and they're like, you accept TRA? And I was like, yeah, the government's going to pay the rent for 6 months. And the deal is, in 6 months, you either have to have a job or be going to school. And then, the government will continue to pay your rent. So I'm like, well, of course, in 6 months, this person's going to either have a job or be going to school, because they're going to get free rent if they do that. So in my mind, I'm like, yeah, this is a no brainer. Of course this will work out. So I fill up the whole building with 3-hourly tenants. And I'm like, oh, I'm the best. I don't need a leasing agent. I don't need a management company. I'm the best real estate investor ever. This is easy. So, 6 months go by. 7 months, no checks come in. I'm like, hey, what's going on here? And then I realized none of them went to school or got a job. And I basically leased the property to like a bunch of people that were homeless and dealing with drug addiction and like, not your ideal tenant, and now I got to file evictions on all of them. So I'm going from like 100% occupied building to like 10% occupied. So just a disaster. And of course they like destroy the unit, they're just like
Mhm.
completely like doing drugs in there the whole time. And like, I'm like, oh, okay. So start from square one. So, real estate is a very management intensive business. You get calls all hours of the night, even if with a management company, you still have to manage that management company because I've hired and fired out actually three of them in my career. And they're really never going to take care of your baby the way you want to. So we started our own management company around 50 units, and it took to get to about 200 units to even just break even on the management. So it's a very cost intensive side of the business too. And it's a pain in the neck to manage real estate. It's for the birds, man.
Yeah.
Being a landlord is not fun. I hate being a landlord.
Mhm.
I don't want to be a landlord. That's why I have a management company and my staff is patient and hardworking and they work like 6 days a week and they're out there, they're running around, they're dealing with all the shenanigans of that tenants bring you. And so it is not a fun part of the business, and so now listen, if you want to own a duplex, a triplex, something like that, kind of get your feet wet, figure out being landlord's all about, listen, more power to you. You don't have to share the pie with anyone. You're going to take on more risks. You're going to sign the mortgage. You're going to have that learning curve. There's a stupid tax anytime you enter an industry and you're going to pay that. I paid it like 17 times. I think I still paid it now. You
Yeah,
know,
but it was your New Jersey. Stupid
yeah.
tax.
Yeah, you got a stupid tax, right? I paid it on cryptocurrency, that's for sure. I got nailed on crypto. I paid a stupid tax there for sure. I got it was stupider. So it's basically at the end of the day, anytime you're coming into an industry, you're gonna fail before you succeed
Right.
and it's not fun. Now, of course, I'm going to say this because I own a real estate investment company and I work with passive investors. I help them build and preserve their wealth in real estate. So, yeah, of course, at the end of the day, my incentive is to help you have a nice experience investing in real estate, a profitable experience. But here's where I see people have the most success. Start passively. Right? Start by investing in someone like me who's been paying that stupid tax for years. I've taken my licks. I've developed a business. I have great deals that no one else would know about. Get in on these deals, put a little money in there, start getting the monthly updates, learn from, hey, this contractor didn't show up. Here's how we're solving that problem.
Mhm.
Hey, this bill was too high. Here's how we figured out how to lower it. Learn from us how we're structuring deals, how we're underwriting deals. Pick our brain, get us on the phone. If you're invested with an operator, he's going to give you the time of day. He's going to answer questions for you. Start by investing passively because it's honestly a safer way to invest. If you invest with the right operator, you're going to get a decent return on investment. A lot of my active investors like, hey, I actually make more investing passively with you and getting a smaller piece of a bigger pie than
Mhm.
investing in my duplexes that never really cash flow and getting 100% of a bigger pie. It's because bigger is better in real estate and better operations is better as well. And then learn from those operators, learn from those people doing it already as a passive investor. And then if you want to break out on your own, start buying properties, do that. You're, probably going to lose a little money. You're going to have some late nights. You're going to have some experience. And maybe that's something you want to experience. That's fine. Nothing wrong with that. Um, but I would say start passive, and then if you really still have that bug, go active. And I know a lot of people that started passive, went active, and now they're back to passive again.
Came
They're like,
back,
"What
yeah,
the heck
yeah.
was I thinking? Just put the money in the pot." Another thing too, like if you're like really good at what you do and you're making money, like the grass is not greener on the other side. Even running a real estate syndication, I know people that are like, "Oh, I'm a really good, CPA or lawyer, like C-suite executive, and I work a lot of hours, but I make like 400 grand a year, but I want to do what you do." And I'm like, bro, you do not want to do what I do. You make 400 grand a year. You're extremely successful in what you do. You went to school for it. Stay the course, my friend. Stay the
Mhm.
course and just invest and diversify your money a long time into what we do. I know some high net worth individuals that invest with us and they've done great with us over 6, 7, 8 years, getting in on every single investment, a 50,000 here, 200,000 there. And they work like 60 hours a week for a Fortune 500 company. They do great and they just invest wisely. And quite
Yeah.
frankly, they're building their wealth almost faster than I am on the GP side because they're just getting in on every single deal, and that's the way to do it. So you can be a really great real estate investor as a passive investor, and just getting in a lot of deals, and that's the way to do it.
Yeah, yeah. Well, you covered the point. I mean, that's really what I wanted to bring out. There's a lot of heartache trying to do this all on your own and by yourself. So, getting in with a group like that is certainly a value. I will conclude on this and just want to ask you one thing very briefly about the market. There's a lot of trepidation out there because people are worried about tariffs and this and that and interest rates and so many other things. What would you say to individuals that might be sitting on the fence because of that?
Well, it all comes down to the famous Warren Buffett line that I don't think Warren actually said, but he always gets credit for it. Is when others are scared, be greedy. When others are greedy, be scared.
Yeah.
And that rings true. I mean, so many investors I know, not the savvy family offices, not the really smart money, but a lot of the more like accredited investors or people like just accredited and trying to build their wealth and trying to make a good legacy wealth for their family. They just struggle with this thought process where they just tend to sell when the market's low and buy when the market's high, and they're scared in times like this, and it makes no sense to me. I mean, prices are down 20%. I'm buying properties for 20% less than I would have paid 2 years ago. But rent continues to grow. Rent is growing 5, 6, 7, 8% a year in these markets. So I'm collecting more money from these properties, but I'm paying less for them. Now, 3, 4 years ago, investors were really excited to invest in real estate. Oh, real estate's hot, the COVID era, not enough of it, da da da. Everyone's piling their money into real estate. Guess what? That was the worst time to buy real estate. Sure, interest rates were low, but prices were extremely high. Remember, as I say, you date the interest rate, you marry your purchase price.
Right.
You can always reset your interest rate. You can refinance, whatnot. You can never reset your purchase price. So if you pay too much for a property, you're married to that purchase price. If you borrow money on a property and you have a high interest rate, you're dating that interest rate. You could always refinance in the future. It could be a short-term relationship. All right. You got to know what type of relationship you got. So the bottom line is now's the time to buy. Prices are low. Rents are high. Yes, you're going to pay a little bit more money for debt. But guess what? It is just another number on the spreadsheet. If you can get a great deal, as we can find now, you got motivated sellers or less buyers in the market because there's less equity in the market. So if you're on the sidelines, right now you had a great run in the stock market. Who the heck knows what comes next? Maybe take some chips off the table. Consider diversifying into real estate or use the IRA strategy, self-directing your IRA into real estate as well, or even 1031. Again, real estate's had a great run. So if you've owned a property for 5 or 10 years, it's probably got a ton of equity. Consider refinancing or consider selling that asset and moving into a passive opportunity in the space. Here's the other thing too: residential real estate, super expensive right now, super high valued. Right? If you own a single family home and you put it on the market and it's in decent shape, there'll be like a bidding war for it. You'll sell it for like a crazy amount. I just did that now. I sold like a piece of crap single family home, and there's like a bidding war for it. I couldn't believe what it went for. But then if you sell like a 6 family or like any type of larger, medium-sized commercial real estate that is in the commercial realm, okay, which is generally 5 units or more, because they don't qualify for residential debt, they only qualify for commercial debt. So 5 units or more. Now all of a sudden you're getting like a low price for it. So it's like, all right, so if you own like something 4 units or less, it's a great time to sell. If you want to buy something 5 units or more, it's a great time to buy. So a smart play could be exit your duplex or your triplex or your quad or your single family home because it's like the height of the market, and move into a commercial investment where they're getting at that 20% discount. And I think prices are going to pop. I think rates are going to come down next year. We should probably have a new Fed chairman in May. He's probably going to be bullish on dropping rates. Housing starts are low. That means inventory is going to drop off the map coming in the next 2 years because it takes 2 years to build an apartment building. So you're going to have low inventory. You're going to have lowering interest rates. You're going to have a perfect storm for property values to just boom into like 26 and 27. So now's the time to buy. You have this window of time. And if you're sitting on the sidelines, in my opinion, it's a mistake.
Yeah, yeah, very good point. I do want to put one caveat. It depends on the market. The market you're in, you got those issues with residential real estate because it varies in different parts of the country. But I certainly agree with that, and I appreciate you bringing up the point about the interest rates. One thing that happened to a lot of folks is that they bought back at the time that you were talking about. And then as
Yeah.
rates rose, they couldn't refinance out those properties because now they didn't cash flow.
Yeah.
And
Yeah. Yeah.
that big issue created a lot of inventory or opportunities in the marketplace, I should say. So yeah, it definitely is a good time to buy because of those dynamics that are probably going to happen very soon.
And I'll just butt in there, Joel. So the reason though, the real, yeah, sure, interest rates increased, they couldn't refinance. That appears to be the issue, but actually the issue was they overpaid for it, right? If they like stole that property for like cents on the dollar, then like they wouldn't be in that whatever interest rates would like be a mute point. It'd be like we did so well on the purchase, but no one did well on the purchase price of real estate from like 2020 to 23. We were all overpaying for real estate. And that's really what happened. They overpaid for the property. They bought it at the height of the market. And yeah, they locked in a great rate, but they dated the rate and they married the interest price. So you basically, you're blaming the girlfriend, but really look at the wife.
Yeah, yeah. So if you got too high of a basis and rising interest rates, you really do have a problem. in a
Yeah.
situ-
Yeah.
like,
Exactly.
yeah, good point,
Exactly.
good point. So be careful who you marry, right?
That's the point we say for this. If you've gotten anything from this podcast,
Right. Yeah, if you got anything from it. So
that's a whole nother episode. Yeah.
absolutely, absolutely. Well, hey, I certainly appreciate it. I think this was a great meeting. I'm gonna ask you to sit tight real quick because I want to talk to you about a couple things as we let our audience go. But we thank you so much for being here today, Aaron. We want to thank you as our special guest this week. And we certainly want to encourage you to always tune in for the Mornings with Joel CRE podcast. We certainly appreciate having you today, and thank you so much for being here.